A very warm welcome to everyone. Okay, so we shall start our sections. So before we start, I would like to introduce myself first. I'm today MC. My name is Eddie here. Okay, and together with me, another handsome guy. Beside Eddie here, you can see our honor speaker, Rudy, is here. So before I hand over to Rudy, okay, to talk about today our main cover topic everyone's concerned about after announcing the Malaysia budget, and also what is the outlook, the market outlook, okay, for this last quarter of 2023. Okay, let me share a bit about our honor speaker, Rudy. So Rudy is our HLA appointed Chief Investment Officer. He also is a qualified chartered investment analyst. At the same time, Rudy having more than 25 years experience in investment and also analyst role, and with his experience, he expand to equity, fixed income, and some mixtures funds that are across Malaysia, Asia, and also global market. So I believe, ladies and gentlemen, today, while you are in here, definitely you will gain something from Rudy, right? And how we're able to continue to advise our clients when we talk about our funds available, right? So without further delay, ladies and gentlemen, please welcome our speaker of today, Mr. Rudy. Hi, Rudy, hand over to you.
Okay, thank you, Adrian. Good afternoon, everyone. So it's Friday. It's late afternoon Friday. I hope everyone's in a good mood since the weekend is just around the corner. So okay, without further ado, let's start the talk. I will just share my screen here. Just see if everyone is able to see the slides.
Yes, Rudy.
Yes, good.
Can. Good to go.
Good to go, yeah. Okay, so the topic obviously is what's stated here. I'm going to talk about the Malaysian budget, the one that was, announced by our PM Anwar just about 2 weeks ago, and what the implications are for markets, for consumers like yourselves, and basically, talk a little bit about other investment market drivers, like what's the economic situation, and what are we looking for over the next, not just for this quarter, but also, taking a peep into 2024 as well, yeah, because we are very close to the year end already. Okay. I'm on the second slide. Can you see the Malaysia budget?
Hey, Rudy, sorry for disturb.
Yes.
Will you want to make it full screen?
It's very small, is it?
A kind of small. So
okay.
We're able to wait, I'm still loading.
Is it better?
Wait, because on my screen is still in. It's not full screen yet. Will it be good, right? Rudy, you unshare and reshare again.
Okay, you share.
Okay, you want me to share? No problem.
You share, please.
Hand over. Okay, cross check. Everyone, can you able to see my screen?
I can see.
Great.
Okay.
No problem.
Okay.
So let me move to the screen 2, yeah?
Yes. Okay. Thank you so much. You help me control the screen then, yeah? Okay. So this is a slide, basically what I've titled here, Budget 2024 at a glance, okay? The budget has obviously a lot of announcement, a lot of expenditure, but I'm not going to go into every little single detail because it's like from the PM's speech, it's almost like a book. But what is the essence of this budget? I will just go through it with you, very quickly. So basically, there is a total allocation spending of 393.8 billion, almost 400 billion, which is one of the biggest Malaysian budget to date. Basically, the Malaysian budget grows every year, because as the country grows, over the course of every year. So the expenditure basically is in tandem with the size of the economy. So this is the biggest budget that we've had to date. And of that amount, almost 400 billion, almost 303.8 billion will be allocated towards operating expenditure. And about 90 billion will be for development expenditure. So this breakdown is not very different from previous year's budget. But the total size of the budget is bigger than last year. Yeah. Now, the government is expecting to fund this budget, this 400 billion or so, by revenue of around 307.6 billion. Basically, it's from tax revenue, right? Area from us, personal income tax, corporate taxes going into the budget, the government coffers. Now, because the expenditure is obviously larger than the revenue, so you still have a budget deficit of 4.3%, right? This is a smaller budget deficit compared to last year, yeah, or even compared to the last 2 years, where the budget deficit was in excess of 5%. I will show you later why the government is trying to control the budget deficit for various reasons. So this is a smaller budget deficit to GDP, but still a deficit. So the budget is still expansionary for the economy. The government is still, spending quite a lot of money, essentially spending more than it is collecting from everyone. Yeah. So what are the salient points of the budget that came up? Obviously, they wanted to expand the revenue base, collect more taxes, generally. And the biggest announcement was, of course, our SST, the sales and service tax rate, will be increased from 6% to 8%, an additional 2%, right? But this includes all your F&B consumption and also your telecommunication services. So there's still, I think the implementation date, I'm not sure if it's announced already, but this SST will basically, hit some other sectors like, your insurance, for example, logistics, and some of the other services that you consume. And also the government is also going to introduce what we call high value added goods tax, a luxury tax, if you like, of between 5 to 10%, right? This will basically exclude foreigners and tourists, but it will be incurred slapped on Malaysians, unfortunately. So your next time you buy a high-end watch or whatever, you will be paying this tax. Yeah. So this is also, the details also not confirmed, because the government, the MOF, wants feedback from various businesses and industries, but we are hearing that things like watches in excess of 20,000 ringgit will be taxed, and high-end luxury leather goods will also be taxed, and even possibly cars above 200,000, but that's to be confirmed. So this will come in effect maybe, I think, second quarter of 2024. So the other major policy move was also the targeting of subsidies. The government wants to remove some of the subsidies that they've always been giving out. So this number one is, they want to lift the controls on chicken and egg prices. That's effective November 1st, 2 days ago. So we've seen, I don't think chicken and egg prices have gone up so much. I think they're still quite stable, so you don't have to worry about that. And there will be, an enhancement of all the electricity subsidy mechanism, and also things like they won't touch the petrol subsidies, but the diesel subsidies will obviously be withdrawn progressively. So over the next few months, you could be seeing slightly higher diesel prices to come. Other than that, there are some, big allocations, like, there's a big fund allocation of 2 billion to the National Energy Transition Roadmap, which basically, tries to make our energy production, the power production, a little bit more energy friendly, a little bit more environmentally friendly. And there's also, continued cash assistance. Now they call the Rama cash assistance to the B20 population. That's increased also by 2 billion now. So it's kind of generally, still a very rakyat friendly budget, a lot of assistance and handouts. The operating expenditure continues to be quite high. Also development expenditure towards infrastructure, roads, schools, and so forth will still be there, flood mitigation. So all this will be spent, and it will underpin GDP growth of about 4 to 5% for next year. This 4 to 5% is not my figure, it's a figure projected by Bank Negara. So I think with this sort of expenditure, I think we can safely say that we should be able to meet those sort of targets, and keep the economy running along smoothly next year without any of the distraction coming from the external sector like exports. Yeah. So moving on, okay, to the next slide. Okay, so why I say budget 2024 was important is important in terms of it setting the tone for fiscal consolidation, right? The government cannot run a budget deficit in excess of 5% for too long, because basically when you are in the government is in deficit, that deficit is financed by government borrowings. So they cannot keep increasing the debt, forever. So as you can see, we need to be, tighten our belts a bit, increase revenue base, and control, but also control at the same time the amount of debt that the government needs to borrow to finance the budget. So this 2024 budget, the percentage of government debt against GDP is going to be, as I pointed there, 63.7. I'll just point out that Malaysia government has a debt ceiling, just like the US. It's a statutory limit of 65% right now. So it cannot go above 65% borrowings. Yeah. This was originally 3 years ago, this was at 55%. But because of COVID, because COVID came in 2020, 2021, this was lifted in Parliament from 55 to 60 and now to 65%. So it is still there. So the government is still, wants to, continue to spend, take care of the rakyat, increase its expenditure, but it needs to do so at a very controlled manner, right? So one of the biggest beneficiary that we see is in this budget is, of course, not so much for consumer, but it's more for the construction sector, where the government will resume a lot of building works, some of the projects that was left suspended during the pandemic period. So it will continue to spur expenditure and private investment in that space. You can see that on the right chart, the blue chart is the development expenditure. It's been progressively expanding over the years, and we're likely to see for 2024 an 8%, roughly 8% jump in terms of the development expenditure here. So that basically will underpin what I just mentioned earlier, the GDP growth assumptions that was projected, which is at 4 to 5%. Okay, next. Okay, one of the things that I need to really have to get it out for this outlook talk is that we really have to talk. What's happening this year is that the global interest rates, especially driven by US interest rates, have moved up very strongly this year, right? Yeah, we all know that the US Fed has been increasing interest rates for the last 12 to 15 months, up to a Fed rate of around 5.25 to 5%. So basically, it's just to control inflation, which they wanted to bring it down to 2% level. So there's always fears that it will tilt the US economy into a recession. So basically, I'm just comparing this chart, which the left-hand chart is what was the policy night overnight rate expectations back in June, where I think a few rate hikes were still expected, and then perhaps in 2024 we will start cutting rates again. So, but currently the expectation in October is for the Fed to pause for a while and maybe increase it by 25 basis points, if at all. There's going to be another Fed meeting in December, and the likelihood of a rate cut is pushed out further towards the second half of 2024. So the Fed will only start cutting rates if they see the economy weaken over next 6 to 9 months. For now, the higher interest rates what we're seeing right now is likely to stay a little bit longer than what we have previously expected. So, but on the other hand, the interest rate hike cycle is basically coming to an end already. We don't foresee that they will increase interest rates any much further, right? So similarly, in Malaysia, also Bank Negara has also been has increased interest rates, but our OPR has basically stabilized at around 3%. And as you know, Bank Negara has came out yesterday that the OPR will remain at 3% without any changes. This is just to support the economy in terms of not trying to create too much of a weakening with higher than expected rates. So basically my messaging here is that US rates is going to be peakish. The likelihood is rate cut will probably come towards the second half of 2024. Okay, next. Yeah, a lot of late, especially although we mentioned that there could be a mild recession in the US, but of late there's more and more kind of like talk in terms of mentioning about a soft landing in the US, which seems to be the mainstream scenario for the moment. I think the last GDP print that was reported by the US, in excess of 3.5%, I think was a very strong one. So perhaps the economy there can basically live with a higher interest rate environment for a little bit longer, whilst inflation remains slightly elevated. So I think the fears of a hard landing for the US it seems to be receding, and the soft landing scenario is looking a little bit more likely going into next year. Yeah. Okay, next is yeah. So so basically, what does all that mean for the Malaysian economy and the Malaysian environment? Basically, rates are quite high, but at the same time, the government is trying to boost the economy by increasing spending. So basically, where rates are right now, I think everyone will see will basically lead to tighter purses for basically consumers and corporates, right? Higher interest rate environment basically induce people to save more rather than invest and use, and also the borrowing will also be a little bit more muted, right? I've got a chart here because it's very topical. The ringgit, our ringgit is almost back to 1998 levels. Basically, why is that, right? Because simply because US interest rates or global interest rates are now much higher than Malaysian interest rates, right? So for a lot of people, it's probably like an outflow. You sell the lower yielding currency, which is ringgit, and you buy into the US dollar. So basically, there's a lot of demand for US dollar right now because interest rates there are so high. It's almost gone back to 1998 levels. However, the flip side is that with a weaker ringgit, I know it hits some of our pockets, it hits some of our spending when we go overseas and all that, but generally it bodes well for Malaysia in terms of the export industry. Basically, we have a very large export segment, which should benefit well from a weaker ringgit. going into 2024. But otherwise, I think, as per what Ben Agarwal has been saying, our domestic economy should remain quite resilient, and the government is there to underpin growth. I've highlighted on the table on the right-hand side, like I mentioned, real GDP growth for this year is maybe not finished for the year, but estimates are it will maybe come between 3.5 to 4% this year. And next year, we're likely to see higher GDP growth rate of between 4 to 5% due to the factors that I have mentioned previously. Okay, moving on to looking at some of the performances of the markets in 2023. So how did Malaysia perform? I think stock markets around the world and maybe also around the region, this year has been a bit of a write-off, because there has been increasing global interest rates. The macro environment hasn't been very good. Exports have been quite soft, and then we also have the China economy also has been weakening. So this year, I think stock markets around the region, you can see on the chart, I plotted KLCI, Hang Seng Index, Hong Kong, Singapore, Indonesia, or most of the ASEAN markets are all in negative territory. And Malaysia is in Hong Kong is down by close to 15%. Malaysia KLCI is still okay, it's still down by around minus 4%. It's still okay. And the only probably outperformer, as I plotted there, is the S&P 500 in US. That has been an outlier amongst global markets because the US economy has stayed quite strong. US corporate earnings have also been quite resilient over there. But having said that, I think what we have seen the last 12 months for the Malaysian market is that yes, it's down by 4 to 5%. And then this is largely also driven by mainly foreign selling. As you can see, the table on my on the right hand side is the foreign ownership the foreign ownership levels, which is currently only at 19.5. It's probably like a 10-year low already. So basically, what foreign portfolios, foreign funds want to sell, want to exit Malaysia or other countries, they have probably already done so. Probably park their money back at the US dollar account, US dollar deposits, or repatriated back home already. So in the last couple of weeks, for example, I think we've seen our local market showing a lot of resilience. It's not, despite US being weak, our market has been resilient. It has not moved that much because I think that a lot of the foreign fund managers who have sold have already gone out. So I see a lot more stability in our market going forward from here. Okay, next one, please. Yeah, so I touched a little bit on Malaysia fund flows here. Basically, it's been a market that has not been liked by a lot of foreign investors. Our market has seen very consistent, the negative gray chart here shows foreign fund outflows. Basically, it's been happening throughout the whole year, the last good 10 months. Only towards July of this year that the foreign money has started to return, and the fund flows have started to turn a little bit positive. But again, in October, there's also quite steep selling. So like I said, despite the very steep selling in October this year by foreign investors, our market kind of hardly moved. I mean, it's down by maybe just 1%. So a lot of the selling has been taken up by the local institutional guys here who are seeing value, especially I think some of the GL4C funds like EPF, have also been buying the market. So I see that the support is now coming back into the Malaysian market because there is value, and the outlook, perhaps for next year, is going to be better for us. Okay, next please. Okay, so what are the plus points, other plus points that I see for Malaysia, going into in the foreseeable future, going to next year? Malaysia obviously is a beneficiary of higher oil prices because we are a net producer of crude oil. Malaysia is also, of course, a beneficiary of FDI. This chart here is the FDI inflow. So inflows have basically is much more than the outflows that we have seen over the past 2 years, largely because I think there's been a lot of trade diversion, following the US-China tension or the geopolitics tension between US and China. So a lot of the MNCs located in China are also relocating their production facilities into ASEAN and Malaysia in particular. So that's where all the inflows are coming in. And also basically, as you know, it provides jobs for everyone and hence, underpins consumption and all that. Okay, so oil prices I mentioned before. Oil prices is important, very important because, Petronas revenue underpins our budget substantially. So higher oil prices will mean that government will be able to dividend out from Petronas the money there and spend it on the economy and the rakyat. And also going forward, I think we will have a much more relatively more stable political environment, right? Given that we will not have any more local state elections or any general election in the foreseeable future, not in the next 2 or 3 years. So I do believe that I think our unity government was likely to hold on to power for the full term, so there will be a lot less political scares that we've seen over the last 1 or 2 years. So these are the little plus points for the Malaysian market going forward. Okay. Now, on the corporate earnings front, we also see a better year ahead. Also, again, due to the various reasons that I mentioned. So one of the reasons why 2023 has been a bit of a flattish year for the market is because we've had very little earnings growth from all the corporates listed in the Bursa Malaysia, especially in the big caps KLCI component counters. You can see that the earnings growth per share for 2023 is actually down by about 3%. So it's a bit kind of flattish, not very exciting. But the market is expecting consensus earnings growth is about 9.8% for 2024. I mean, this looks a little bit optimistic to me. I'll be quite happy if earnings growth can come in at around the 5 to 10% trajectory, because at the end of the day, I think it's not so easy because costs are also rising and all that, and basically at a GDP growth of 4 to 5%, we basically will have kind of maybe high single digit corporate earnings growth for the market. So that's what we are expecting for next year, and the so dividend yield also will be quite resilient for the market, which will also be one of the underlying reasons to stay invested, because our dividend yield is quite attractive right now at around 4 to 4.5% return. Yeah, so the next slide, yes, okay. So that's the outlook for the stock market, which I've just gone through. I touched also a little bit on the bond strategy, what the fixed income outlook is for many of you who may be invested in fixed income funds or fixed income market. So I basically touched a little bit on the US Treasury market, right? Basically, I've charted this here, which is the US 10-year yield versus minus the 2-year yield. Basically, we call it the 10-year to 2-year spread. Essentially, right now, the 10-year yield is higher than the 2-year yield. So basically, we say that the yield curve is actually slightly inverted. When there is a yield curve inversion, it usually predicts a recession will come in the foreseeable future, because in the future, market is expecting the government or the Fed to be cutting rates, right? So your long-term rates are basically lower, they're slightly lower than your current 2-year rates. The 2-year short-term rates are usually mirrors the Fed rates a little bit more closely, which is close to around 5% level right now. However, having said that, I think in recent weeks we have seen the 10-year yields also spike up to close to 5%, although now it's come off a little bit to like 4.9. So the yield curve is now kind of a little bit more flattish throughout, hugging around the 4.8 to 4.9% level. So basically suggesting that we may not have such a hard landing after all, in the US. So that's the US market for you. Next is the Malaysian bond market. Now, the Malaysian bond market I think, in the coming quarters will be a lot more stable, a lot more stability compared to the last 2 years, because I think that the interest rate cycle has basically normalized, and Bank Negara has come out also to say that our BNM, our OPR is going to remain likely to remain flat at around the 3% level. So one of the chart that I've shown you here is that the total foreign debt security holdings, right? How much foreign investor hold of our MGS, right? So it's actually for this year, there's actually been increasing, coming in to buy our government bonds actually, and it peaked at around 280 in July. Last 2 or 3 months, there's a little bit of selling, but overall there has been some very good inflows from foreign investors coming in to buy Malaysian government bonds. Basically, they kind of like see that there is value there here, compared to other places that they invest in now. And most of all these foreign investors are largely fairly long-term investors, like central banks or basically federal governments, also pension funds who are basically in for the long term. So they're not really hot money that comes in and out quickly. So that's why I see that it should the bond market should remain relatively quite stable for Malaysia, given that the investors here are in for the long term. On the next slide, essentially also basically on the fixed income market, the biggest holder at this moment in time obviously is the pension funds. And again, I mentioned foreign investors. So pension funds is largely our EPF, basically, which is a very big holder and player in the market. They have been net buying, and largely because you can see on the right hand chart, the EPF total contributions in 2023 has been up very strong. It hasn't been that strong over the last 3 years, as you know, because the government has allowed people to withdraw their savings from the EPF during the pandemic. So they've basically essentially lost more than 100 billion over the past 2.5 years. But since second half of 2022, I would say that contributions have picked up very strongly, because post the lockdown, post reopening, economy comes back, and then everyone has unemployment stabilizes, and everyone is back in business again now, essentially. So they've seen very strong outflows, very strong inflows into EPF, and hence that has augured quite well for the bond market, where we see EPF anchoring the market, anchoring most of the new issuances also coming into the market. Okay, so next. So I basically charted here the long term, the 10-year yield over the long term over the last, this is probably an 18-year chart. So the green line is where our 10-year yield is. Our 10-year yield right now is yielding at 4.1% as per this chart. But the last few days it's come off slightly. It's come off to about, I think, 3.8, 3.9, thereabouts. We think that at this particular level, MGS yields are actually quite attractive. Vis-a-vis the historical spread that we have seen against the overnight policy rate. The OPR is now at 3%, whereas the spread of the MGS 10-year is more than 100 basis points. It's around 1%. So we think that MGS rates are quite attractive, and it's probably a good time. I mean, you're a bond investor. It's a good time to be getting in to enjoy those higher rates. So the OPR basically hasn't changed. As I mentioned, the last hike was on the 3rd of May. We expect maybe in the next 2 quarters Bank Negara to stay put at 3%. I think given that inflationary expectations are likely to be under control, and then also the Bank Negara's, according to their messaging, they want to be supportive of the economy and not raise rates, to too high a level. So basically, I think we think that current valuations where the bond market is right now is quite attractive for investors. Okay. So so that's it for my outlook. Essentially, I will basically run through some of these are some of our HLA funds, the performances of our fund. I think so. Growth Fund, Blue Chip Fund, Dana Putra are our Malaysian equity funds. From a financial year to date, I think financial year to date means it's starting from June. The funds have done quite well. They are all in positive territory because the market has rebounded. The range around 2.5 to our Dana Putra fund is 5%, slightly above the benchmark. But of course, on a 3-year return, it's slightly negative because the benchmark itself is also down in the same manner. Our managed fund, which is a balanced fund, I think it's quite the returns are still quite stable. Year to date 2.3, and over 2 years, it's also beating benchmark. Right. Okay. So income fund is our fixed income fund. Okay, 3 months 0.7%, and over 3 years it's 8.65%. Yeah. And the flexi fund is our flexi, essentially equities fund with a flexible asset allocation. Those returns are also quite stable on a financial year to date basis, and also on a 3-year return basis. Right. So I will emphasize a little bit more on our funds. So this is the HLA Venture Income Fund. Like I said, I think this is a pretty good time to be entering into the fixed income space because yields are quite high, and you can enjoy fairly good returns. As you can see, the fund year to date was according to this is 4.9% as at end August. But I think as we get closer to November, end of November, December, it should return around 5 to 6%. So very good returns, and it's got a very long, consistent track record over the years. Obviously, way above the benchmark, and the volatility of the fund is quite low and stable over the past many years. We haven't had any default corporate bond defaults over the past over the life of the fund essentially. So investors do get to enjoy very good stable returns if you were to be invested in the venture income fund. Okay, next is the managed fund. Like I said, currently our asset allocation for the managed fund is around 50% Malaysian equities and 50% Malaysian bonds. That also has a very consistent track record and superior returns over the benchmark. Year to date is at roughly around 3%. Given that the index is pretty much flat or down slightly, and the 3-year, 5-year outperformance numbers is also quite good. So if you are stayed long invested over the long term, I think you could get very strong overall returns, basically in line with the fund's investment objective and philosophy of delivering strong long-term capital appreciation. Okay, and lastly is the Blue Chip Fund. The Blue Chip Fund is a pure equities fund. Again, I think it's a balanced focus of delivering capital gains and also having dividend income. So the fund also consistently beats the benchmark, which is the KLCI. So if you're invested in it over the long term, you should be able to enjoy quite superior returns. So I think that's my last slide already. So basically I think that concludes my presentation. So basically I think just in a nutshell, I think as I said earlier, a quick summary, a takeaway for you is that I think 2023 has been, quite a difficult year, with global interest rates rising, which is never good for equities market. We've had some macroeconomic slowdown in various large economies like China, for example, and elsewhere in Europe. And also, Malaysia has also faced some headwinds also with, the ringgit. There was some political uncertainty with state elections. So all this seems likely to be behind us. So the outlook in 2024 is possibly, I think, likelihood is going to be a better year for us, especially with corporate earnings growth basically resuming its 5 to 10% sort of growth trajectory, which will all go well for the market. And for fixed income investors also, I think it's also a period where you have quite attractive yields right now at around the 4% level and above. So yeah, basically that's the takeaway for you in this presentation. So thank you so much. So I will basically open the floor up for question and answers.
Yes, Rudy, thank you so much. Thank you so much for your sharing on the budget as well as the market outlook. So, wow, I can see that there have a number of questions that appear in our Q&A sections, right? So the very first question, Rudy, for you. So is it healthy to have a deficit of budget expenditure versus the GDP?
Malaysia has run a budget deficit for a long time, since the mid-90s, right? You need the budget deficit, you need to have high budget expenditure basically to sustain the economy, basically to achieve your goals of your GDP goals, right? Whether or not is it healthy, it is not healthy to have a very high deficit for a sustainable long period of time. And that's why I said it cannot sustain a deficit of 5 or 5.5% for too long. That is essentially too high. So what the PM is doing is trying to bring it down to around, for next year's budget, 4.3%. And their longer term target is to bring the deficit down to 3% or below. Now that is actually a more sustainable budget deficit over the long term. It will be very difficult for Malaysia actually to have what we call like Singapore, right? A balanced budget or a surplus budget. Essentially, you tax more than you spend. Because Malaysia has a very narrow tax base. A lot of people don't pay taxes still. Not just the underground economy, but in terms of the tax scale, there's a lot of loopholes and tax evasion and all that. And basically, that's why the previous government, the two governments ago, introduced GST, which is very broad-based, and it really lifted the government revenue. But GST, on the other hand, not popular, right? So it was voted out. So we're not likely to see the GST come back anytime soon. I don't think not during the current administration, because one of the manifesto of Pakatan Rakyat was to get rid of GST, right? So that's why we still have the SST, and the PM has decided to increase the SST a little bit more to 8%.
Yeah, thank you, Rudy. Thank you. Because when we talk about the SST, right, yesterday I also heard from the FM, right, that currently government is still planning to remain SST, right, rather than replaced by the GST itself. So I believe by having this, right, we can see a bit more stable on the tax part. So Rudy, I think there's some questions, right, in their mind, right, because in this couple of weeks, we keep on listening that the ringgit have keep on weakened, okay, versus the US dollar, right? We have achieved about 4 ringgit 70 cents. Then we let's say we versus with the Sing dollar, right? It's about 3 ringgit 50 cents. So what is your view on this part? Because let's say our currency keep on this level, or possible it may worse than this level. So will it still bring a more worse scenario on the coming couple of months? or this? What is your view on that when we talk about currency?
Yeah, I think the currency weakness, as I touched on a little bit earlier, is basically due to the interest rate differential between the US and Malaysia, right? Right now US has a much higher interest rate, just basically on absolute levels. If you put money in US deposit, you can get 5% and more. So it's basically this interest rate differential, which is basically leading to our weaker ringgit, right? Essentially, you see that it's just not our ringgit which is weak, right? The yen is also weak because the yen has 0% interest rate, right? And some of our peers in the ASEAN region also, well, all those currencies are also quite weak, right? So my view is that when what we call the US Federal Reserve pivot, right? When it starts to, okay, they have been very hawkish, increase. So now it's basically peak already. So when they start to pivot and start to lower rates, I think that US dollar will likely to weaken quite significantly, and that could happen maybe in the second half of 2024. So I think till now we will probably see a weakish ringgit, and that applies to most emerging market currencies as well. But weaker ringgit obviously is bad only if you're importing stuff, and it could create some inflationary pressures. But at the same time, it is good for exporters, and it's partially also good for the economy in some ways.
Okay, great. Thank you for sharing on that. Then second questions, right, that in my heart, I also wanted to check with you is, right, just now when we talk about the OPR rate have remained, right, yesterday, the Bank of Ghana also has announced that we will remain the OPR rate. So will this remaining, right, is able to achieve their planning, right, to grow, to continue to increase the spending power for the nations, right, to active the markets?
Yeah, I think, yeah. So Bank of Ghana has this balancing act to execute, right? On one hand, you want interest rates to be not so high, stable, so that people can still borrow for whatever business needs, or for property or whatever, right? So it's important to have also important to have a very supportive rate of interest for people to be able to lend, and for corporates also to not basically sag them with too high borrowing costs, right? And that will be very supportive for the economy in general, and that is what Bank of Ghana wants to do. So they will likelihood is they will probably stay flat at around the 3% OPR rate. But of course, like I mentioned also earlier, this has a cost. The cost is your ringgit is likely to depreciate. If you want to have a lower interest rate vis-a-vis the developed markets like the US, because there will be fund outflows when you have that sort of scenario. So I think the more important point here is that they want to keep the economies, they want to be supportive of the economy, and also try to hit a healthy level of GDP growth for next year. That's the main objective.
Okay. So the next question here, right, I would like to ask you is, right, what is your view in our economy outlook for Malaysia in 2024, which means next year? So just now you have shared that there's a high chance that our economy able to rebound next year, right? In the on that. So when roughly on your point of view, roughly when you started to able to feel the market?
The economy, yeah, we think that there's a very high chance of a rebound, as I mentioned. This year is kind of weak. We will probably at 3.54%. So next year, like I said, the public expenditure from the government will underpin the economy, and also next year, like this year, for example, our exports are very weak. If you've seen the export numbers, is probably down by 10 to 15% every month, and because there's basically most of the major economies are also weakening. So next year is likelihood is that we could see a rebound there, where exports are going to be not as weak. So that will also help Malaysia's GDP growth going forward. So there's, of course, all this is contingent upon all the major economies improving. Like for example, as I said, China has been weak, but will it get better next year? Yes, hopefully, because China is also doing a lot of their own stimulus strategies by increasing expenditure, trying to encourage consumption of that. So everyone is trying to make the economies healthier going into next year, right? So we do foresee that the economic projections should be better next year, and that would augur well for Malaysia's growth as well.
Then I do have, in the chat, right, they have another questions for you. So what is your view, right, when we talk about the Malaysia tech infrastructure industry? So whether the infrastructure industry, right, the tech infrastructure industry, right, whether it competitive enough, okay, versus the others country and able to have an opportunity to take advantages for this view.
Oh yeah, as I mentioned, our FDI flows have been very strong. So a lot of major US, European funds, electronic companies have been relocating some of their production facility into Malaysia. So our what we call E&E sector, the electronics sector is likely to be, I think, still remain quite strong. If not, is expanding, because all this new FDI will also have a flow-through effect on some of the other industries as well. So that's why the government is, like our PM has been very hard at work, visiting all these countries to try to increase FDI flows. So I think within that particular sector or space, it should remain quite resilient. But of course, it also depends on generally where the global economy moves to.
Okay, thank you so much. Now I do have another questions. Okay, I think this is not it's a very common question for you what is the best funds to invest among so many funds choice that we have?
Oh, okay. Best HLA fund to invest.
Yeah.
They are all very good. No, seriously, I think there's no one particular fund which is best to invest. I think it will also a lot depends on your customer profile. So I would basically say that if you are recommending a fund to a more mature, slightly older customer who perhaps likes a little bit more steady returns and less volatility, then the fixed income fund, our HLA venture income fund, will be very suitable for such a customer profile, right? Because it will give you strong stable returns, much more over your FD rates. So yeah, the venture income fund. So but if you have a customer who is willing to take a bit more risk, who has a longer time horizon, he's a little bit younger and all that, then the equity fund would be more suitable, right? For example, our blue chip fund and also our HLA growth fund, because you can see over the few charts that I've shown just now, over the long term, these equity funds will also deliver for you quite nice sustainable returns. Although in the interim, you will see a bit more volatility compared to fixed income. So if you're staying invested, I think you usually buy a policy which is quite long term also. So if you stay invested for the long term, I think you will be able to enjoy those superior returns anyway. Yeah. So that's my
Thank you, Rudy, for your advice on that.
Yeah.
Okay, we take note on that. I saw today's section is very active, you see, because keep on, they have a lot of questions coming in. But ladies and gentlemen, due to the time constraint, right? Okay, I will take this as the last questions for today. So, Rudy, the last question here today is right. China facing problem in their construction industry. So, will this continue to affect our Malaysia economy in 2024? Will it have a direct impact?
It will not. It will not really have. It will not really have a direct impact. Because of why? Because Malaysia is not a very big exporter in terms of building materials to China. They get their resources from essentially elsewhere and internally lah. But of course, what I'm talking about, what you're asking me, the China construction industry. So that should not be a very direct impact per se, right? But having said that, what the indirect impact is that China right now has a little bit of problems also with the property sector, right? The property cycle is a little bit low. That's why the investors' confidence there is kind of low, and consumption expenditure is also affected. So you have all that basically leading to very low consumer confidence and all that. Those things will have an indirect impact on Malaysia more, right? Because, like, for example, if the Chinese are from China, when they have low low confidence in the economy and all that, they will spend less, they will travel less and all that, right? And they will, we won't see as many tourists as we have seen before COVID, right? So basically, of course, we want them to travel out, spend money everywhere in Malaysia and elsewhere, so that it keeps the economy going now. And also basically our exports, the demand for exports needs to be sustained. So yes, China can be a very important factor, but like I said, the Chinese government is also doing a lot of things to try to stimulate the economy. So we foresee that 2024 will be a better one than what we've seen this year.
Great, thank you, Rudy. Thank you for your explanations. So, ladies and gentlemen, thank you so much for your participations. Okay, I believe every one of us, right, definitely will gain something from Rudy from just now the about 50 minutes of the explanation, and also one in the Q&A sections, right? So, okay, once again, thank you so much, Rudy, for your time. Okay, for that. So we hope, okay, incoming we do have more and more sections that able to organize with you, okay, to invite you to talk about more on what the market outlook in 2024 in the coming next year, right? So thank you, Rudy, once again, and thank you everyone for joining us. So have a nice day and a happy Friday, everyone.
Thank you, everyone. Have a good weekend.